You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. And as you said many times on the program, if you just come into Vol Views for the first time, first off, welcome. And then secondly, you should definitely spend some time after you listen to this episode. Check out our archives. Great interviews, including the one we just did last week with our old friend Chris Cole from Artemis. A lot of you guys writing in with some comments on that one. A lot of you liked it and found it very interesting and controversial, which we try to get some discussion going here with our interviews. But there's quite a few more of those in the archives. Great discussions and debates about all different types of volatility scenarios and trades and strategies, etc. So check it out if you have some time and you're interested in digging deep into all things volatility related. We're going to do something a little bit different on today's program because, quite frankly, I've been consumed most of the week with the big Options Alliance conference that just concluded yesterday here in Chicago. So December 10th, for all of you listening a little bit after the fact. And if you're not familiar with the Options Alliance, it's a group that I started a few years ago that has really grown quite a bit to really try to foster the entrepreneurial side of the financial and indeed the options and derivatives markets. And so if that sounds like you, if you're listening to this show, maybe you have aspirations to become a professional trader, or maybe you are one, or you work in this capacity, in some capacity in the space, I should say, in terms of looking at the opportunities that those skill sets provide you from an entrepreneurial perspective, then the Options Alliance certainly is for you. You missed our big event, unfortunately, our big annual conference, our third one now, so growing quite a bit, has expanded. We include venture capital showcases, marketing for financial startups, and we even had a big financial startup showcase to conclude the event yesterday. So it was a fantastic event. People came in from hither and yon all over the country to attend. So if you're not familiar with it, we're going to put up the media from the event in a little while. Certainly on the network, you'll be able to get some of the panels in podcast form. We'll also have some videos up there on the Options Alliance site. You should also, of course, surf on over to optionsalliance.org to learn more. Follow the group on Twitter as well. We're just at Options Alliance. We also retweet a lot of that stuff there through our at Options handle as well, so you can find it there as well. So if you're wondering why we're doing a little bit shorter, a little bit different format today, it's because that show just concluded and that pretty much consumed the entirety of my time and resources as well as that of my staff this week. So we're going to take things a little bit differently on the program this week. A little bit shorter show, and also going to focus a lot on your questions because you send in so many of them. We don't have time to get to them all the time on the program. So we thought we'd do a little bit of that today. And joining me here, a little bit late, but better than never, he also someone who I believe is worn out from the realm of all things Options Alliance. I know he was there yesterday, and he did an able job moderating his panel on how to launch a fund in this day and age. The greasy meatball himself, Mr. Mark Sebastian. Mark, welcome back to the program. I hope you're not as worn out as I am from the big Options Alliance shindig yesterday.
It was a blast. So many cool different facets of it. My panel was really great. I think we had a really good round of discussion. The marketing panel was interesting, and of course the M&A group. We had a couple of new guys and a couple of returning guys that really added a lot of value, and I think really answered a lot of questions. I think the big note that I took out of the M&A panel was one of the pieces was from Adam, where he said, one of the problems with the Chicago fintech market is that it's its own little bubble, and then there's this technology bubble, and then there's a bubble in healthcare, and they don't actually all communicate with each other. So that was something I thought was kind of interesting.
Yeah, that's a big goal for our group, the Options Alliance, is to try to get those bubbles to start talking to each other more. In fact, we've reached out many times to try to get the tech community more involved in what's going on the financial services side from a startup perspective and other communities. And so we're doing a lot of that outreach at the group. So far, the other communities seem to be pretty much focused on their own thing. But when they start waking up, I think the explosion of fintech and the popularity of that is really going to maybe start creating those bridges particularly between the tech and the financial community, because they're starting to see, wait a minute, there is a lot of tech going on out there in their derivatives markets. It's not just people standing in pits waving old cardboard and paper cards anymore. It's a little bit different these days. Speaking of a little bit different, Mark, I was just telling the people we're going to do something a little bit different on the program today. We're going to focus, because you and I are both completely spent. We're going to actually focus on some of their questions, some of their content today. So I want to do this for a while anyway. Getting towards the end of the year, a good time to devote to some of our listeners. So I think without further ado, we're going to dive right on into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. Like the man says, it's the portion of the show where you guys get to take the reins, your questions, your comments. Not many of you brave enough to leave a voicemail. At least that's for public consumption on the show. A few of you use that line, but more to share your thoughts and opinions with us here as opposed to with your fellow listeners. But if you are of the brave, you have a little bit of the fortitude in your spirit to leave a voicemail you'd like to have read on the show, go ahead, dial that number. And if it's an interesting one, family friendly, we'll read it on the program. Some of you might be asking, hey, where's our other compatriot, Mr. Russell of the corner office fame at the SIBO? And he's actually on a plane coming back from Singapore right now on Showtime. He's been over there for the last few weeks, kicking off the big new Options Institute in Singapore. He also gave us that great rundown at like 2 a.m. last week from the RMC Asia. So he's been a trooper for the program of late. So we don't begrudge him a little time off, particularly because he's on a plane right now. So it'd be kind of weird for him to do the show from, I think, a seat 16C on the flight back from Singapore. But that said, Mark, before we get into the volatility voicemail, I don't want to truncate you because if you have something you want to share with the listeners. So if there are some developments, something interesting that really caught your eye in the week that was from a volatility perspective, before we dive into the volatility voicemail, have at it, sir. The floor is yours.
As I'm looking, I'm seeing a borderline panicked market. We have the VIX up 5. You have the December future up 3.5. You've got the January future up $1.50, and we are backward through March. February is trading slightly above March, and so we have a curve that is now saying that we are in danger of a serious sell-off and serious follow-through from this. So, I mean, you don't typically see the S&P only down 30 and the VIX up 5. This is a ginormous vol move. There is a lot of people scared into this weekend, and everything sets up for some sort of phenomenal tank job. Maybe Monday. I mean, they're pricing in a lot of weekend risk. I'm a little surprised and quite flummoxed by how hard VIX is moving. I mean, we thought VIX was going to move ahead of the Fed, but this is serious, and there are a lot of people worried about this alleged high yield meltdown and bond meltdown and things like that. I mean, let's see how quick the SEC is to the draw on dealing with mark-to-markets. If they don't do that, then who knows? Because, if you pull up HYG, which is the high-yield bond ETF, it is down 3%, almost 3% today, and its vol is up 7 points today, up over 18%. So there is some issues, and people are worried, and that's just something to be on top of. You got JNK, which is similar to HYG, is also down about 2.7%, and its vol is getting near 19%. So, you do the math. There's some real variance hedging in VIX, and that is what's pushing everything higher. I mean, the December future is trading 22.70 right now, and the VIX cash over 24, threatening 25. Think about that. There is some fear.
Yeah, that's probably the best way to put it. You're right. We are in the midst of a protracted sell-off here. Most of the major indices off over 1.5%, as Mark was saying, and VIX cash up over 5 handles today. So all of our predictions before, none of us really predicted into the mid-20 handle in VIX cash land. So interesting. We are in a little bit of uncharted waters, or should I say really not uncharted because we have been here before, but more unexpected waters. Of course, feeding into that frenzy, we saw consumer spending gapping up pretty hard this morning. PPI also up, all of that feeding in to that rhetoric, that argument, that discussion that the Fed is indeed going to pull the trigger next week, even though most of that you would have thought anyway that was baked into the market already going into today. But today's aggressive sell-off on top of what Mark was talking about with all that fun on the mark-to-market side is really laying into the market today. Of course, Mark, quick to move and SEC are not two things you usually hear in the same sense. They tend to be reticent by design over there on the regulator side of the fence. All right, and moving on to your questions for the show today. Going to kick things off. You guys are all over the place, which I love. Your questions really run the gamut, which makes this show fun. Let's kick things off with a question from Pick6. He writes, "Hey, I'm concerned about pin risk. I know open interest is the primary indicator, but are there any other tells besides open interest for pin risk besides," he says it writes, "perhaps implied volatility?" That's interesting. I can't recall anyone writing in asking about the correlation between vol and pin risk before, so that's why I like you guys. You keep us on our toes. The truth is, you're right. The initial, the primary, the 99.9% indicator for open interest is pin risk. Remember, pin risk is really caused by all that gamma hedging, that kind of gravitational effect of all that positioning, all that gamma on a particular strike. So in order to have that, you really need a lot of open interest. You need a lot of volume on that strike to really create that effect, to suck the underlying to that strike and keep it locked there to create that pin risk. So without OI, it's kind of really not going to happen. That said, there could be a few other things. If there could be some rare scenarios where on expiration day, for example, there could be a strike with minimal open interest and it's near the at the money, which is an unusual scenario in and of itself, but let's say it happens. And then someone comes in that day and puts on a bunch of long premium or whatever the case may be and gets a big gamma position on that day. And then they could have a similar impact if that were to happen, in which case you would look at volume of that day. But again, volume is kind of a bit of a corollary to open interest. So there's kind of two sides of the same coin there. But aside from that, vol is, if you scan in for pin risk using vol, you're kind of missing the point. I mean, there could be a little bit of correlation there. Again, if there's a ton of long premium, for example, people are really buying a ton of positions, you're probably going to see vol elevated on that strike. So that might be a bit of a correlation there, but you're kind of stretching it at that point. Really, OI and then that day's volume are kind of the two things that really going to have any impact on pin risk. Mark, a bit of a weird one out of left field. That's why I like our listeners. Anything you want to add on maybe some random correlations between implied vol and pin risk?
Yeah, I don't think it's that big of a deal, but I mean, I definitely think that it does have some effect on when there's really, really open interest on maybe that very expiring day, but really not to.
Yeah, all that goes without saying. We've said many times on the show before, pin risk is kind of a bit overdone in a lot of these big names out there. The notion that, I think this kind of goes hand in hand with that kind of old school belief that, options are this giant market moving kind of weird, strange, arcane force that dictates where the underlying goes on any given day. And we've kind of debunked that many times here on the show in the past. Options and options market makers don't have the power a lot of people ascribe to them. That said, expiration day could be one of the few days when that happens, and in some weird scenarios it can happen. But in general, pin risk itself is overblown, and then be looking for implied vol as some sort of tell for pin risk. Yeah, you're much better off looking at OI and then maybe a relation that day's volume as well. All right, let's see. How about this one? This one comes from Charles M. He writes kind of something we touched on a little bit last week on the show. It's kind of a growing area of study. He writes, how has the dwindling number of option specialists impacted volatility? I believe volatility has increased as a result, with days like August 24th being glaring examples. Please discuss. So if you could call listeners, I brought this up with Chris on the show last week because this is a growing topic of discussion. And he kind of mentioned, which is the true state of it right now, is that it's on a lot of people's minds. A lot of people are starting to, ascribe to this belief. There isn't enough data, and there's not enough research to been done to really. There's no smoking gun paper has come out yet and said, okay, bam, here's the reduction in number of specialists. Here's the, let's say, post-Dodd-Frank reduction in number of large banks that can actually play in these products, AKA here's the structural increase that we've seen in volatility going forward. That said, it does seem like there is a lot of smoke there, and there may be some fire. I know, Mark, you've said many times on this program you believe we're in kind of this new volatility regime. Today notwithstanding, we're in the 25 handle, that the new kind of median is around that 15 level, and that is indeed a relatively sizable structural increase in vol going forward. A lot of that probably could be traced back to the relative dearth of people out there backstopping this market, particularly in a lot of these big products like the S&P and the institutional products, like VIX and others. So I think there is, like I said, there's no smoking gun research yet, but I think there's a lot of different evidence out there pointing back to the same potential culprit. Mark, I don't think you and I have chatted about this that much, though. What's your take on this? Do you subscribe to this belief, or are you kind of you're a skeptic?
Well, I think one of the things to understand is that where volatility, where the liquidity is what really the prime effect is. There used to be liquidity out 3, 4, 5, 6 months, even into the leaps. Now liquidity is in the weeklies and in the very front month options, and then completely non-existent beyond that. There is a serious issue with liquidity in that respect, and that's really, I think, the major driver of what's going on, and where the lack of market makers and lack of market participants has affected things.
Yeah, I'm looking forward to maybe in the next RMC next year there'll be some papers on this or somewhere else, because this is. A lot of people are talking about this now, that it's got to get some data behind it, and then I think we'll see for sure. But I think I'm kind of in the same camp as you, Mr. Charles M. That I'm leaning that way myself now. Another M coming in. Hey, Melendez. He writes, hey, any updates on VSTOXX? Is it coming to the U.S. anytime soon? It's good timing on this question. I was just chatting with these folks a few days ago, and they are indeed, looking to extend their reach into the U.S. They're not idiots. They've seen the success of products like VIX. VIX has really paved the way for all other volatility players. They've shown that there is a demand for this, not just in the institutional, which anyone could have predicted. Like I kind of laughed off the VIX futures when they first talked about it. I thought this is going to be the mother of all institutional products. And the CBO first told me about this back in, 2004. Who the hell is going to trade this except for some really huge upstairs OTC, institutional client and some of the listed guys in the SPX. And that's really about it, because at the end of the day, it was looking like a layoff product for the whole SPX pit risk from a vol perspective. No retail guy is going to touch us with a 10-foot pole. And here we are a decade or so later, and could I have been more wrong? No, the retail has embraced VIX like it's going out of style. It's crazy. And we've seen, of course, the moniker of the Fair Index has helped quite a bit. So other products like VSTOXX, they see this and they want to try to, ride that wave that VIX has created. A few issues with VSTOXX is that they have their European product coming out of Eurex, obviously the Deutsche Börse group over there. So they have some regulatory hurdles to overcome. I believe they have clearance on the futures here now, and I believe they're working on the options to get CFTC approval on those. And I believe that's the case. Maybe it's vice versa, but they're looking to get both products approved, and I think the time frame they were telling me is sometime in Q3 of 2016. They expect to have that approval by. Again, regulatory approval is a bit of a fluid thing, but that's what they're expecting. So if you, like a lot of people, were kind of turned on to VSTOXX after the big Ukrainian fiasco and the explosion of volatility out there in Europe, and you want something that maybe approximates that a little bit more, then you wait a little longer towards Q3 of next year, you may be in business. Mark, we talked about VSTOXX before. Anything you want to add here on the VSTOXX product, or just your thoughts on European vol?
I mean, VSTOXX is pretty active, actually. It already, of the other vol indexes, it's definitely the most active. And it's one to follow. And especially if you're going to be trading a lot of Europe, you absolutely need to be aware of what's going on there and what this volatility index is saying.
Now, I did have a volatility researcher just a couple of days ago try to tell me that he did some research and thought that pretty much across the board they're kind of all the same, and that VSTOXX doesn't really and VIX aren't as far apart as you might think. That's only one guy I've heard that from. I haven't had a chance to verify that myself. I wouldn't mind checking that out a little bit more myself and see, because I know particularly after the whole Russian-Ukraine thing, that really you saw a lot of action out there in the VSTOXX product. So I'd imagine those types of environments, I would think VSTOXX would be the outperformer. But I think once we see these things listing here in the U.S., more U.S. clients and customers becoming aware of it and getting out there, I think we'll start to see those differences become a little bit more stark, a little more realized in the marketplace. Let's see. Talking about studies and things like that, we got a question from Zach06. He writes, hey, can you recommend the definitive study on VIX calls versus S&P puts? Is there an ultimate winner? Well, I'm assuming he means the strategy and not is there an ultimate winner for the best paper. I'm going to go the latter there. And in terms of the ultimate winner, we said this many times in the show. If you actually want to hedge, I don't know anyone out there who really looking to actively day-to-day hedge a big, broad, S&P type portfolio that doesn't lean on the S&P puts versus the VIX calls. VIX calls they're not really a hedge. They're a kicker. We've said it many times. And there are some scenarios where VIX calls do outperform, and we talked about this on the show before too, and that is like those scenarios like we saw like August 24th when the market is melting down, and that's when VIX outperforms to the crazy upside. And that's why you want to be out there to capture those moments. The rest of the time, not so much. It's not a product you want to be in those types. That's why we've said things like those 1x2 type strategies where you're writing some narrow term premium, yet you have table stakes for the big gap up has been an effective strategy out there of late. You're not exposing yourself to as much of the risk of the long premium out there in VIX, and yet you have some skin in the game should the thing really explode to the upside, which is where you want to be. And all the studies that I've seen, and maybe Mark, you've seen a few new ones that are a little bit different, but all the ones that I've seen have really said that S&P puts are the clear and clear winner unless you factor in those few aberrant moments, in which case, in some studies, depending on the time frame you're looking at, VIX can be the overall winner from an overall return perspective. But that, if you're looking for a hedge, you're looking at more of an intraday kind of product to hedge your vacillations in your portfolio. And if that's the case, you definitely want the S&P put. But Mark, I don't know, this seemed to be more of a hot topic, a few years back when VIX was kind of really becoming a big thing with a lot of the public, and there's a lot of research done on that. It seems like this is a bit of a settled argument now. I haven't really seen a lot of new papers on this subject recently, because it seems like most people have kind of come in weighing in on the S&P put side. Have you seen anything new? You were at the more recent RMC than me. Have you seen any more recent data on this?
I think it's all about kind of the time frame and duration and cost. I think the S&P does a better job if you are on top of it, but the costs are a lot higher, if you're actually hedging a long-term portfolio, I think there's actually an advantage to using VIX in that whole sticky strike scenario. I generally come from, I've definitely moved my school more to the crisis alpha, use VIX and S&P when you actually need them. And in that case, if you're coming from more of a crisis alpha, the Thompson boys type of approach, VIX actually does work better in those respects, at least at onset of a crisis. But, generally speaking, I really think it's very situational dependent, and I used to think it was a lot more cut and dry than it is. That said, I think probably, VIX futures maybe does as good of a job as either of them as kind of an alternative approach. So I've moved, I've evolved from clear winner S&P 500 to, it's much more situationally dependent than I thought.
Yeah, it's true. You've always been a big fan of that crisis alpha, as you put it. I mean, you've espoused on the show in the past that, S&P puts, even as expensive as they are still underpriced for those aberrant moments when the market is melting down. And I don't think anyone would argue with that, except for the fact that, getting to those moments, paying the table stakes and, maintaining that position throughout the entire year, whether it's S&P puts or VIX calls, that's where the challenge comes, So how do you keep your skin in the game while you're waiting for those moments? So that's kind of where I think the challenge for a lot of people is now, including yourself and others, is how do you do that while you're waiting for that big swing to the fences? But that's interesting stuff. Yeah, and I haven't seen, I think one of the most recent ones I saw on this subject was that you have to do some funky things to really make the VIX outperform. And I think what I saw was, it was out of the money call calendar spreads in VIX. I forgot how, it might have been 5%. Versus S&P puts and put spreads. And in that scenario, the way they configured it, and again, it's all in the devil's in the details, and the way they configured it, the VIX outperformed because it helped capture those aberrant movements in there and helped finance the position a little bit. So that was one of the more interesting ones, and that was a few years ago, and that was probably the most recent update I've seen on this particular scenario. But who knows? Maybe we'll see some more interesting updates to this in the coming months, and hopefully maybe next year by the big main RMC, which I think is in February next year. Coming sooner than we expect. Maybe we'll see some interesting new evolutions on this thought process. All right, moving on to more product questions. We got AL33T or Elite, if he's trying to be a cool elite guy. He writes in, hey, looking over the Voldex info recently, and I can't figure it out. Why would I want to remove skew from VIX? Isn't that valuable trading info? He's, of course, referring to the Voldex proposed product. It's not really a product yet that ISC and the Nation Shares guys have proposed out there. We had them on the show a little over a year ago to discuss the idea, and he's right. That's essentially what the premise of the product is taking, I guess you can call it the more old school approach to VIX, which is just taking the front month at the money implied of the S&P, SPX, and then just cutting out everything else. So not getting those downside puts or the upside calls or any of that skew that really weighs into the calculation right now. Yeah, and we've talked about this before on the show before, Mark. I think you're on the same camp as I. That I applauded that move when they added skew. I always thought that they were missing something with just that front month at the money, because that's not where all the vol trading is happening. It's happening in all kinds of places in that term structure and in that expiration cycle, including in the puts and in the call wing and everything else. So I think you need to take that into account to get a more holistic picture of that front month vol. There's issues with it. There's the carpet bombing we talked about before, which is still out there. We highlighted it on a recent show. People were loading up garbage puts in the SPX to try to get some sort of resulting effect on the print. But overall, I think that's a more realistic picture. Mark, I think you're in the same camp, right?
Yeah, I really, I think that the way VIX calculated, there's a method to that madness, and I'm a proponent. So, yeah, I'm not so sure about the Voldex. I think, trying to do another, one of the presentations we saw yesterday was the Voldex guys, and you know what they said that was a nice admission was, SIBO has the volatility index. They own implied volatility. There's, it's going to be very tough to be competitive with them, so we're not even going to bother. And I think that's one of the issues these Voldex guys are going to have.
Yeah, there's a few issues there. I've talked to them for, and they're still looking for the underlying, whether it's going to be an ETF or a future. That's obviously a big component of any product. Kind of need an underlying to make the options work, and so that's kind of where I think they're stuck right now. Yeah, but maybe there might be an audience out there for this. You know, I'm not poo-pooing the product. If there's someone out there who wants to trade it, good for you. You want that at the money implied, you don't want to deal with it, there you go. There's your choice for it. I don't see the use case for it myself. Speaking of the Voldex guys, really quick, I was talking to them. They were, of course, at our big Options Alliance conference yesterday, Mark, and they were showing me some interesting data ahead of the show, which is kind of interesting. It was a histogram of kind of the, I guess you can call it the predictive capacity of products like VIX and how it shows relative to where VIX is predicting and whether VIX is overestimating implied volatility or underestimating volatility relative to, of course, historical or realized. And as you might guess, given the way VIX usually works out and the risk premium in the market, that histogram was very much skewed towards the VIX over predicting the level of volatility in the marketplace, which is kind of interesting because you look at the other side of that chart, which is kind of where all the paper is lined up on VIX. Of course, we're talking about being calls. People come into VIX all the time to buy upside calls. That's kind of the primary use case for the VIX options. And that was dramatically smaller to the point where there are very few events, and I think the time frame was 10 years on that study, where VIX dramatically, underestimated overall volatility. Granted, those few events are where things are really rocking and rolling, so you can do all right in those events. But looking at the overall raw data in terms of number of returns, it didn't paint a rosy picture for the call buyers and the premium buyers out there in VIX land. What's your take on that? You think that surprised you, or is that pretty much what you expected?
I mean, VIX is overpriced almost all the time, except for, like you said, in those really, really ugly scenarios. And that's the issue you have there, is that the times where it's not underpriced and where it's not overpriced, it's really, really, really not overpriced. It is severely underpriced at those periods of time, and that's what you have to be aware of, and what really I think differentiates those few time periods where VIX does blow up and underpredict.
Yeah, that's really where everyone's waiting for those moments out there. So even if there's few and far between, if you can capture them, like August of this year and the subsequent weeks, then you can do all right, to put it mildly. All right, a lot of product questions coming in on the show. This one comes from Avery. She writes, "Hey, why do you guys take such a dim view of TVIX? Am I missing something?" Yes, you are. You're missing all of our shows from about, 2 or 3 years ago, whenever that big TVIX implosion happened, where it was kind of our topic du jour on the show. And if you are an advocate of TVIX, Avery, and others out there, I recommend you just go pull up a chart of it, and you could see for yourself exactly why and what happened. And maybe a little bit of a hiccup all of a sudden. You look at it and say, that doesn't look right. Of course, you're not familiar with a TVIX. This is the Velocity Shares 2X VIX short-term product. And it had a few issues, and to put it mildly, a few years back. And it wasn't like we said many times, the issue with all these products and these structured and these ETPs and ETFs out there is the way they're constructed. And it was a structural issue with this product. They had, I believe it was a massive inflow of funds, and it just simply couldn't handle it, and the product broke down quite literally. So the returns it was generating and the performance it was generating had nothing to do with what was going on in volatility, with what you're trying to buy the product for or sell it for. It was structural issues with the product that were driving it completely down. And that's not what you like to see, obviously, and that's a sign of a very firmly broken product. The thing still exists. The thing still trades pretty actively as of today. It's done 32.5 million shares already. Its ADV is about 22 million. So today, obviously, a rockin' and rollin' day. So people are still out there, and people apparently have short memories of these products, maybe because they're trading a levered ETF to begin with, or in the short term. But still, yeah, this was one that we take a dim view on, yet it still rocks and rolls. I don't know, Mark, anything to add on the big TVIX fiasco and kind of TVIX going forward and some of these other products out there that may be a little bit dubious?
Yeah, I mean, you've got a lot of those products that you have to, all the ETNs, you really need to understand what they're about and what they're doing before you do anything. And then that's what it comes down to, is understanding understanding the nuances of every index, and that's really the key. And TVIX and UVXY are which is its clone, are no different.
Yeah, I love the clones. Attack of the Vol Clones. Man, that's a good title for the episode. We'll see. All right, I think we got time for one more. Doing a little bit of a truncated show this week for the reasons we outlined at the top there. Let's see what's going to close it out here with a question from Vin C. He writes, what is the correct duration to purchase VXX puts in my retirement account? I like the best chance at capturing the most erosion over time. If you guys know, if you're listening to the show, that's one of our favorite longer-term kind of safer set it and forget it type vol trades. As we've said many times, the term structure of VIX futures in most scenarios, today's obviously a little bit of an aberrant period, but these weird scenarios aside, in most trading scenarios, that term structure is going to disadvantage products like VXX because, of course, you have buying longer term expensive vol, selling cheaper vol. Over time, that erosion is going to build into the product. So if you get longer term bearish positions like puts in a product like VXX, over time, it's going to work out. And there are some aberrant scenarios where this thing surprises us and it performs to the downside more aggressively than we thought. So you can do it shorter term, but in general, it seems like a year plus is the better time frame. I think, and personally, and maybe Mark, you've had some different scenarios. I think some of my better results have been a little bit longer, like in more like I think the 16-month window, a little bit longer time. You want that erosion to kick in, not all the way out to like 2+ or 3 years. You don't have to go crazy, but it seems like in that 12 to 16-month window seems to be a decent time frame. And Mark, I know this is one of your favorite trades for your own retirement accounts as well. Where do you find your preferred duration for this kind of thing?
I go out with the 2-year leaps, and I've actually gone from using VXX to using UVXY. So doing the double. And then, the key is these do reverse split every now and again. And when they reverse split, you need to close your trade and then wait a couple of days and then get back in once they actually do reverse split, because the liquidity just dries up.
Yeah, so maybe set it and forget it is a little bit optimistic, but you don't have to do as much hand-holding. But you're right, you have to pay attention to some of these moments when these little nuances of the product kick in. Again, like we're saying with all these products, the devil is in the details. A little bit of an update here as we're talking. This market continues to rock and roll to the downside, and we're lighting it up from an overall volume perspective. Like I said recently, VIX hasn't really been lighting it up. The ADV south of 600 contracts, 1,000 contracts, I should say, about 587,000. Today already, we're not even at 1 p.m. Central here yet and already pushing 1 million contracts. So like we said earlier, a bit of an outperformance to the upside here in VIX cash, and the options and indeed the futures are moving and trading commensurately with that. So a lot of stuff to watch, and looks like next week is going to be a crazy one. So maybe without further ado, we'll get on into the crystal ball, and then we can wrap it up for this week.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the crystal ball. Like the man says, this is the portion of the show where we look ahead and see what the vol gods hold in store for us. They are fickle, those vol gods, as we can see just from this week. No one really expected a mid-20 handle in the VIX cash as of this week. And so, again, it kind of just goes to confirm what Chris was saying last week, which is really just a roll of the dice when you're picking this near term. That's what makes it so fun at the end of the day. And yeah, of course, we are still in aggressive sell-off mode, and VIX cash a little bit south of the 25 handle now, dropped below there, about 24.5 right now. It was over the 25 handle earlier in the show, but still a lot rocking and rolling. So, Mark, kind of a weird week ahead. We got, of course, Fed is imminent, as they have been for some time. Today's data kind of reinforcing any last-minute doubts there may have been that they weren't going to act. Really seems like they're firmly in that camp. Of course, some of these other issues really helping to exacerbate the sell-off to the downside. So kind of anyone's game where we're going to be this time next week. I got a feeling you're probably not going to guess mid-20 handle, but I don't want to put words in your mouth. So where are you guesstimating for this time next week?
I think there's a good chance that, who knows? I think that there's a decent chance that you could see by midweek higher than where we are now. Probably not by Friday. I think we'll back off from here. But I think that we're setting up for vol bid into the Fed meeting and then kind of a collapse out of it. That's the way everything's lining up for me.
Yeah, I think that's a pretty good guesstimate there. I don't see us selling off too aggressively till the big Fed announcement, which is kind of the last big structural volatility item on the calendar for the year. That's kind of what everyone's waiting for. I'd be surprised if at this time next week we were still at these levels. I would guesstimate we'd be south of the 20 handle by this time next week, given how everything at this point should be shaken out. But then again, you never know. The Fed could cause some surprises. There could be some other issues. Someone could invade someone next week. China could do something crazy yet again. And we could still be in this elevated range, but I would be quite surprised. I'm going to go on the south of 20. I'm going to take the under for next week, and then we'll see how it shapes up for next week. But that's all the time we have for the Crystal Ball segment. Also all the time we have for this episode of Volatility Views. But before we go, as usual, check back in with the greasiest of greasy meatballs to see what he's cooking. I hear a rumor, Mr. Greasy Meatball, you guys now have some sort of store over there in the land of the pit. Tell us about that.
Auction Pit has a store. We started that. We had a great Black Friday. Everything went well. My hedge fund's doing well. We're sitting in cash right now, Mark. So I'm a pretty happy camper with what I'm seeing today, and hoping there's more behind it.
Cash is a position. People forget that.
Cash is a position, and I intend to engage some of that cash next week. That is my plan. How? Well, that's the secret sauce, folks.
Oh, so people are actually paying you to do something with that cash? I thought you were just holding their cash for them.
Yeah, no, exactly. That's me.
Then you'd be called a banker.
Yep.
Mark Sebastian, he'll hold your cash for you. Now check it out over there, of course, optionpit.com, and you can search for Carmen Line if you want to learn more about that. I'll let you figure out how to spell it. That'll be the test for if you're worthy of being one of his investors or not. All right, that's going to do it for this episode. Of course, I want to thank all of you out there for sending in such great questions. We love to hear from you guys. If you have a question about the land of Vol and all the things going on therein, send it to us. We love to hear from you guys. Questions at theoptionsinsider.com. We're on Twitter at Options, of course, on Facebook, The Options Insider, and over there on StockTwits, we're Options Insider as well. Or if you have some other means of conveyance, carrier, pigeon, etc., send it over. We'd love to hear from you guys. And we'll see you next time for more Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.